Hello friends, welcome again. This is Skadvisory Private Limited. In this video, we are going to learn the new series on Japanese candles. In this first episode, we will talk on the most famous candlestick pattern called hammer. Before we look at the real charts, we will quickly review the logic of these charts. If you don't know how these patterns work, you can watch our previous video sessions called Basic Knowledge on Chart Patterns. Let's begin with the reviewing the hammer. Hammer is the simple bullish reversal pattern, which means that the pattern is formed by the one candlestick only and implies that price will be going down, and after the pattern appears, price will reverse to the upside. It is easy to say you cannot accept price to get reversed when pattern appears. We will see that all patterns fail to attempt time to time. This is what the video series is really about. However, the hammer pattern implies the bullish pattern. Hammer is the candlestick with the small bullish body sets in the upper range and is relatively large lower tail or lower shadow. The fact that hammer is supposed to appear in the bottom and has a relatively large lower tail, that means there is some buying pressure happening in the lower tail. Where this pattern comes from, if we try to imagine the creation of the hammer, you can see that price opens in its upper range, then it traces to the downside. It only counters when there is some buying pressure, which makes the candlestick close upper range, lower tail or the lower shadow in this case mark the buyers to dare to give a hint the price is about to reverse to the upside. All that, of course, that all is just a theory. Let's move on to the real charts to see how the hammer pattern appears. Observe when it works or fails also. The first chart is the 4-hour chart of the Bitcoin against the US dollar. As we can see here, there are two clear examples of the hammer pattern working exactly as it is supposed to. There is quite a lot of difference between these two hammers. Both form a perfect form of definition. Another interesting detail is the hammer on the left has much more pronounced lower tail, which implies much large buying pressure at the bottom. However, this hammer didn't lead to its bullish reversal. There was dramatic buying pressure implied in the lower tail. Hammer pattern on the right had a large pronounced lower tail, and it ended up leading to a larger reversal. There might be various reasons for this. One of them is that the hammer pattern on the right is also a bullish harmonic pattern at the same time. Let's now observe few cases of hammer pattern that failed. The second chart we have an 1-hour chart of the Ethereum against the US dollar. Instead of just picking random charts, this could very well be the daily chart of the stock or 1-minute chart of the standard currency. This will really matter. Other candlestick patterns work in the exact same way markets in all time frame. In this chart, we can see 3 examples of hammer patterns failing to produce good signals. Patterns were only kept for producing small bodies to the upside. Even though all these 3 patterns were alright, it's important that you become away from this sort of things. It can happen because there is very important lesson happening here, which their alliance slowly on candlestick pattern is not that corrected to the trade efficiently. You need more tools in combination to produce reliable trades to sustain in the long trade. The other chart we have the 2 hours gold versus the US dollar. Interestingly enough, we have an example of hammer pattern failing in the left hammer pattern and working well in the right hammer pattern. This all shows once again that trusting well these patterns by themselves is not always a good idea. This chart is also a good candidate to show how the hammer pattern is traded. One of the advantages of the hammer pattern is that it provides an automatic stop loss level. In other words, a particular shape of the hammer patterns automatically creates a very convenient and easy stop loss level. This level only friends to a few pips or tips below the lower tail of the hammer. This is a logical stop loss because after a hammer, a trader wants price to be reversed to the upside, and the lower tail of a hammer provides a cushion for buying pressure. In this lower tail, the entry happens at the open of the very next bar of the stop, a few pips or few tips below the lower tail. It provides a relatively small stop loss order in the relatively high reward potential, which is what traders should go after. A swing trader goes after the 1-2-3 risk reward ratio using these patterns can quickly see the first pattern generate the stop loss, the second hammer will generate a profit. Notice that you should use the 1-2-3 risk reward ratio. One profit is enough to neutralize 3 stop losses. That can give you a peace of mind when looking for opportunities. That's it for this video. In the next episode, we are going to take a deeper look into the inverted hammer. If this information is helping you, then do like, share and subscribe to our channel and press the bell icon to be notified on every update from SK Advisories. Thank you.